The following radio program is for informational purposes only and is neither specific nor tailored financial advice to any individual. It is not intended as an offer or solicitation for the purchase or sale of any financial instrument. Always do your own due diligence and consult a financial advisor before making any investments. Investing involves risk, which can result in the loss of any or all principal. Peter Weitz is a registered investment advisor with Fusion Analytics Investment Partners, LLC, an SEC-registered investment advisor, as well as a registered rep with Fusion Analytics Securities, LLC, a FINRA registered broker-dealer and SIPC member. All views expressed in this program are those of the host or guests and do not reflect the opinions of Fusion Analytics Investment Partners nor its affiliates. Your investments. How secure are you that they are secure? Do you want to know more about investing, retirement, and moving to the next level in business? Welcome to In Black and Weitz, featuring host Peter Weitz. Our program will answer all of the questions about your future and so much more. It's all about smart business and smarter investing. Now, here is your host, Peter Weitz.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. Thanks for being with us and thanks for listening. Please make sure you follow me on Twitter. My handle is @PeterWeitz, and on my blog, inblackandweitz.com. I'll be posting some information from today's program. Today I'm actually not going to have a guest because I want to talk about something that is coming down the pike and has actually hit here, but there's some interesting requirements. For those that listen to the show regularly, you know that I focus my business practice on the management of 401k plans and the investments inside of them. And the IRS, as they always do, changes the tax laws and the regulations that are associated with the tax code. And it's this year going to impact 401k plans. And so I thought I would talk a little bit in today's program about plan restatement and exactly what that means. Well, let me just give you a quick definition, is that all defined contribution plans and the documents, which include 401k plans, profit-sharing plans, and any kind of money purchase plan, so basically any business with any kind of defined benefit / defined contribution plan is going to be affected by this, will need to restate their plan document, meaning they're going to have to do their plan document over again and rewrite what exists no later than April 30th of 2016. Well, I realize that's, slightly over almost 2 years away. But let's go back. The IRS imposed this deadline starting on May 1st of 2014 and gave us 2 years to do it. So now we're 3 months into this, but it basically should get done sooner than later so that you know you're in compliance. Well, most of the third-party administrators that have your plan documents have already incorporated these changes, and it's simply having you do a new document. But let's discuss what some of those changes are and what they mean. So approximately every 6 years, the IRS requires that plan documents be updated and resubmitted for review and approval. Like I said, most third-party administrators have probably already received approval by sending in their documents, but they still have to incorporate those changes to make sure that your document is in compliance as well. And if you don't, there is the potential in an audit to lose your tax-exempt status. So this updated document should be kept along with your other copies of your plan documents and so forth. And if you're ever audited by IRS or the Department of Labor, it's going to be one of the first things that they ask for. So what is what they're calling this year the PPA restatement? So what exactly does that mean? Well, the PPA restatement is named after the 2006 legislation that was passed by Congress in what was termed the Pension Protection Act of 2006 as it relates to retirement plans. And it includes the following, and I'm going to talk about these briefly. It includes automatic enrollment provisions, which is a provision that a lot of plans are starting to incorporate now, where if a participant becomes eligible to participate in a 401k plan, they are automatically enrolled in the 401k plan to start saving money. The IRS got together with the Department of Labor on this. And, for those that have listened in the past when we did our show on behavioral finance, you'll remember that most people have a tendency to do nothing. And there is this inertia to keep the status quo. So if I were to go to a participant and say, Mr. or Mrs. Participant, congratulations, you are now eligible for your company's 401k plan. Fill out the following 10 documents or 4 documents, whatever a case may be, and you can enroll into the 401k plan. Well, chances are that those people are going to put the pieces of paper on their desk or bring them home to show their spouse or, one of their consultants, and time's going to go by and they're going to do nothing. And time will continue to go by where they have yet to invest or continue to invest in their own retirement. Well, with automatic enrollment, that role is reversed. So the inertia goes the other way, being that all of a sudden now you're enrolled in the plan, and my conversation with a participant would go as follows. Mr. or Mrs. Participant, congratulations. You are eligible for the 401k plan, and you've automatically been enrolled, and 3% of your income is going to be put into a retirement plan on your behalf to be joined with the corporate match of X%. If you do not want to participate in the 401k plan, please fill out the following 4 pieces of paper and turn them into your HR benefits person, and you will be inactive in the 401k plan. So following that same logic, having automatic enrollment has allowed or increased, and some studies show at least 20% more people participate in a corporate 401k plan because of automatic enrollment versus not having it. So that was highlight 1 of the Pension Protection Act of 2006. So the second thing is that with automatic enrollment, there's an opt-out. It allows for automatic contributions to be returned to employees without a tax penalty if the employee opts out of participating within 90 days. So again, it goes back to that inertia. So let's say the employee says, I don't want to participate, I can't afford it, and so forth. If they've made contributions, they can remove those contributions, get the money back, provided they do it within 90 days. The vast majority of people that make these decisions don't do that within 90 days, as they just can't get around to it, and that behavioral finance with that inertia kicks in as usual. The next thing that was highlighted in the Plan Restatement, PPA Act of 2006, said that disclosures that workers receive have to relate to performance of their pension plans. And this became a big issue with some of the larger corporations that provide 401k planning, in that they now had to disclose to every participant on your statement exactly what your fees and costs are going to be for each mutual fund, for each provider, the financial advisor, the third-party administrator, the record keeper, and custodian, what all of them would be charging you, the participant, out of the growth of the assets of your plan. And it's allowed for a lot more fiduciary responsibility and a lot more scrutiny from employers as they look into what these fees actually are. Investment advice rules changed as well. It removes the conflict of interest for giving certain types of investment advice to participants in retirement accounts, particularly if there is what's been known to have, or what's been called self-dealing. If a particular investment or 401k provider has their own investments and they steer you towards those own investments, there's disclosure rules that require that they tell you that. The biggest example would probably be Fidelity or maybe Vanguard. They're going to want you to buy their funds as opposed to the entire universe of what's available. Well, that has to be disclosed. Contribution limits have changed a little bit, and they will continue. But they also, the last thing the PPA, the Pension Protection Act of 2006, did was it established what was called a qualified default investment alternative or investment arrangement. Okay, and it says that it's designed to protect employers from liability of losses suffered by automatically enrolled employees. And there are certain funds that qualify for this. Interestingly enough, money market is not one of them. But most of the target date funds and some stable value funds do qualify. And so if a participant is automatically enrolled and they elect to not participate and they elect to not actually fill out any investment related decisions, then the money that's put into their account on their behalf will go into what's called this qualified default investment alternative, and it'll be invested for them in something that's a moderate low risk, but a little bit better than money market. So that's sort of where the act changed in 2006. And what plan restatement is going to do is it's going to incorporate all of these changes that were created in 2006. But in addition to that, it's going to add the language for all the tax law changes that have occurred. So going back to plan restatement is that the IRS requires that we restate a plan document every 6 years, and it encompasses 4 years worth of tax changes in tax legislation. So we're actually going to be adding in this particular restatement period the tax changes that occurred between 2007 and 2011. So any of the tax code changes that occurred in that period are now going to have to be incorporated inside of this plan document. And some of those changes are, and I'm not going to get too much into them, but 415 regulations, which are a big, tax code, the Pension Protection Act, which I just went into in a little bit of detail, the Heroes, Earnings, and Assistance and Relief Tax Act, called HART, which is geared more towards the wounded veterans or veterans that have returned from active duty, the Worker, Retiree, and Employee Recovery Act, Katrina Emergency Tax Relief Act, and the Gulf Opportunity Zone Act of 2005. So these are some of the things that are going to be affected inside of the 401k plan. So again, to recap, the IRS every 6 years requires you restate. You have to put all of these new provisions inside of your plan document to be in full compliance with IRS regulations and with any Department of Labor regulations. If you do not have these inside of your 401k plan, there is a potential that you could lose your tax deferral status for your employees, and I can imagine that that's not a place where any of us want to go. So what's the timing again? Defined contributions must adopt all these PPA provisions no later than April 30th of 2016. The timing of the restatement of your plan depends upon several factors, including and not limited to the type of plan that you have, the plan size, and the number of amendments adopted for your current document. Your third-party administrator should be able to help you with that. But if you choose which cycle to adopt these changes of plan, you may want to adopt your PPA restatement. So here's my point. My point is that all these changes need to be made to your 401k plan. You have to add all these additional clauses, tax clauses, labor clauses into your plan document. It creates the perfect storm, the perfect opportunity to actually consider your whole 401k plan in its entirety, thinking about what exactly you offer for benefits and features inside of your 401k plan. And since you have to do this anyway, what great opportunity it is to look at the whole versus the parts. And we're going to talk a little bit more about that right when we get back from the break. You're listening to the In Black and Weitz radio program on Voice America Business.
When it comes to business, you'll find the experts here. Voice America Business Network.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
When it comes to business, you'll find the experts here. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. I'm talking today about 401k plan restatement requirements and what's coming down the pike for you as not only a plan sponsor, administrator, but also as potentially a plan participant. And, you know, one of the things I focus on in my practice in the 401k space is making sure that you're ahead of the curve and you know what's coming. And today, as I mentioned, I'm talking about plan restatement. And, you know, again, to recap, 401k plans have to be updated from time to time to conform to changes in the federal tax laws made by Congress or to reflect official guidance issued by the IRS. And if you don't adopt an amendment on a timely basis, or you're a late amender or even a non-amender, your 401k plan won't comply with the law and it's no longer tax favored as a qualified plan. Well, imagine if you're an administrator having to explain to all your participants that they're no longer getting pre-tax deferrals inside their 401k plan and they have a big tax bill coming because you failed to file a timely amendment. Well, the IRS is giving you time to do that. They're giving you 2 years from May 1st of 2014 to do so. But if you were listening to the first segment and I mentioned the behavioral finance inertia piece about how people just tend to do nothing, I know that you're going to say, I have 2 years left to do this. I'm going to let it sit on my desk and I'll get to it in a year, year and a half. Well, you know, you don't want to get to the point where it's too late. So for those that are technical on this, it does come down to, it was IRS Revenue Procedure 2007-44. So I mentioned that this began in 2007, and it requires 401k plans to be amended and restated every 5 years on individually designed plan or 6 years on pre-approved plans. The vast majority of people are on a pre-approved volume submitter plan that third-party administrators put together. Very few do their own individually custom-tailored administration, but it does require that. It also establishes deadlines for amendments. And so we're talking about this right now. So going along those lines, in 2014, starting now, anyone can submit their amended changes and get that approved and be done. However, if you have a safe harbor plan and you have the safe harbor provision inside your 401k plan, you actually cannot amend your plan until 2015 because safe harbor plans cannot have significant amendments adopted during a year. So it's going to push most people into 2015 because they're on an annual cycle. And so that's one thing that you definitely want to note. Some other facts, and then I'm going to switch gears about what you should be doing after you restate your plan. But some other facts I want to point out are, what if you miss the PPA deadline? It's going to, again, potentially disqualify your plan and bring on some additional penalties. You have to act promptly to review your document and make sure you get this done. So that's important. How will the process work is a question I've been getting asked frequently. and it's essentially a 6-step process. You'll be notified by your third-party administrator with a plan design memo that you can make notations as to any changes that you'd like to make, and they'll incorporate all the changes that the IRS and the Department of Labor have made, and then that'll get reviewed, and they will design a new draft of the plan, and you will review it. Once you agree to it and sign it, it'll be submitted and incorporated into your plan document. So that's important to know. But here's the part that you don't know. And this is why listening to my program on a weekly basis is important. So plan restatement's coming down the line, and there's absolutely no way around it. You have to do it. Third-party administrators are licking their chops. Why? Because it's open season free money time for plan administrators, where according to an article in Plan Sponsor magazine, it opens up the floodgates for them to charge you an additional fee to restate your plan document. And the fees on average in the study that they did nationwide are around $1,300 a year, $1,300 to restate. So if you don't know plan restatement's coming down the line, and all of a sudden out of the blue, your plan administrator or third-party administrator sends you an invoice for $1,300, or in some cases I've seen it as high as $3,000 for a bill for something that you don't know about, you're going to be pretty upset. So my thought is, if you know about it ahead of time, you know it's coming, it's a great opportunity to shop. It's a great opportunity to look for a new vendor, new suppliers, new advisors, to make sure that your plan is in the best possible light that it can be as a fiduciary acting on behalf of the participants. So from my perspective, I think getting the word out, and what I'm trying to use this medium for, is to make sure that you're aware that you're going to have to do it, but use it as an opportunity to look over your entire plan as a benefit and make sure that you're getting all of the features that are available in the marketplace, but that you're also getting the best possible investments, the best possible advice, and the best possible fees based on the size of your plan. So that's a little bit on plan restatement, okay? Let me shift gears for just a moment and talk about things that you should, if you're going to take the route that I just explained of considering opening up the floodgates and looking at your plan in its entirety, what are some of the things that you should be looking at? Well, you want to make sure that you know who your vendors are. And we've talked about this in the past when I had an ERISA attorney on the program, but there are really 3 vendors inside of your 401k plan. There's your financial advisor, there is your third-party administrator, and there's your record keeper / custodian. The record keeper / custodian is going to be who holds the assets and who keeps track of the daily valuations of those assets. The third-party administrator is going to handle the day-to-day administration of moving the money around, who gets what, distributions, changes in allocations, changes in how much people want to participate as a percentage of their salary. And the financial advisor should be involved in not only the financial management, as in picking out the investments, but also in the educational and ongoing advice phases of a 401k plan. And as I've mentioned in the past, this is something that we do on a regular and frequent basis. In fact, our goal with our clients is to maximize fiduciary protection, because we leverage our unbiased research, our regulatory expertise, and our financial management expertise to help do so. And so there's really a significant amount of components that go into that. So the question begs is, when was the last time you heard from your financial advisor regarding your 401k plan? If it's been a long time, then the chances are when you look at your plan restatement, you're going to have outdated funds, you're going to have expensive investment alternatives, you're going to have lack of education and advice. All of these requirements are in direct violation of the Pension Protection Act of 2006, and it's something that you're going to want to change. What the Act did, particularly as it related to some additional legislation in Rule 408B2, which came out in 2008, it requires you as a business owner, as a plan administrator, to take a larger fiduciary role against your participants. You are supposed to act in the best interests of your participants, not the best interests of the company for which you are employed or own. And that difference has been significant. So I had an example in the past where I represented a company and I knew that there were cheaper mutual funds out there, the exact same mutual funds that were available, but I knew that they were available in a cheaper expense base than what the current plan had and what the administrators knew about. Well, to make it a simple example, let me explain it this way. I want to buy a 12-pack of Diet Coke. And on one side of the street, the Diet Coke is $3 for a 12-pack. And on the other side of the street, the Diet Coke is $2.50. Well, it's the same Diet Coke. It's the same 12-pack. It sits in the same case. It's going to taste the same, but yet it's 50 cents less. Why would I not want to buy the cheaper Diet Coke 12-pack than the more expensive? And under the legislation that Congress has enacted, that's a requirement, is that you need to be able to give your best efforts to make sure that you're responsible enough to give the cheapest alternatives to your participants. Plans that haven't been restated in this 6-year time period are dealing with outdated, more expensive funds and need to make the changes. So I put together a list of what I think is important, 16 questions that you should ask your 401k providers when you're restating your plan document. These are questions they should have answers to in order to be able to put the best plan together. And I'm going to share hopefully all of them with you over the next hour. But I'll begin by saying this. Let me be honest with you. The topic of 401k plans probably doesn't excite anyone. It happens to excite me, but I'm wired a little bit differently. But why should it? Because most are under the impression that there's little difference from one company's plan to the next. And I see this all the time. Name brand recognition in my field is huge, and that doesn't necessarily mean you're getting the best product. But companies are drastically underutilizing 401k plans to attract and retain talented employees because they don't have the best plan on the street. But like most product and services, as I've mentioned, there's a powerful difference amongst plans with a couple of tweaks and a couple of changes, such as eliminating any conflict of interest and excessive fees. A company can transform a plan into a key component of their employee benefits package. Changes, as I mentioned, will help a company attract and retain its most talented people, and plan participants will have a more secure retirement. Add to this that it can all be done in a way that can reduce the overall costs. And now I think you've put something together that might actually be exciting to talk about. In fact, I'll add this in there. In the current workforce, and this was a study that was recently completed by the University of Michigan, said that employees that are actively looking for work are more interested in benefits packages specifically than they are in just salary alone. And if a company does not have the most robust retirement package along with healthcare and others, they may not attract the best talent just because they pay the highest salary. And that piece alone tells us how well educated our new workforce, our Generation Y workforce is, because they're so focused on retirement as a piece of the total package. And I think that that's a big, big deal. So when you're thinking about your 401k plan, again, you have to restate your documents. Knowing you have to restate your documents, why don't you look at the plan as a whole and put together a better plan that's going to help to attract and retain employees? And I'm going to give you a list of 16 questions that we're going to talk about right when we get back from the break. You're listening to the In Black and Weitz radio program on Voice America Business.
From the boardroom to you, Voice America Business Network.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Voice America Business Network, the bottom line in business.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. My name is Peter Weitz. I'm talking today about an IRS rule that requires all 401k plans to resubmit their plan documents and redo their plan documents. And I mentioned in the last segment that it's most likely a revenue generator for third-party administrators who are going to charge you a large fee to do so. But if they are, well, then let's take a look at your plan as a whole and figure out a way to make it better. And so take the IRS's requirement and let's turn this into a positive to make sure that we can build the best plan possible for our employees. So to do that, I've compiled a list of questions that you may want to ask yourself, but ask all your vendors to make sure that you know that you've got the best plan in place. So the first question is, does the plan provider receive payments from the plan's mutual form in the form of revenue sharing agreements? Most administrators, most plan providers do receive revenue sharing agreements, and there's nothing wrong with that. However, it needs to be disclosed. The reason it needs to be disclosed is so you can evaluate what that cost is over all the other fees and costs inside the plan to make sure that it's in line with other plans that are out there or in line with market standards. So according to industry regulators, in fact, I mentioned that 90% of 401k plan providers receive money from revenue sharing. And it's important to understand this, but you also have to make sure you understand whether or not it's considered a conflict of interest. It's obvious as providers base their decision on the payments of the mutual fund. You don't want to have a mutual fund company that pays the highest revenue share in your plan because it's just simply not in your best interest. It's in the best interest of your providers. And so you want to make sure you deal with that. So as a fiduciary, your biggest area of vulnerability is to make sure that you can eliminate any potential conflict of interest. And that's important. In my response to that, or sort of my take on that, is fees are extremely important because every dollar paid in expenses is a dollar that is not compounded over time to help finance retirement. And so I look heavily at fees and expenses. And I'm going to give you a simple example. The impact of an additional 1% in expenses is substantial when compounded over a 30-year working career. So let's suppose I've got two people who start with $50,000 in their retirement plan at the age of 30. Both invest the same amount and achieve the exact same returns over that 30-year period, okay, which I'm going to assume is 9%. However, in my example, right, Joe has $50,000 in his account returning 9%, but he pays 2% a year in expenses. And Mary has $50,000 in her account, same thing, earning 9%, but she only has 1% in expenses. At the end of that 30-year period, Joe's value is just over $380,000, while because Mary has 1% less expenses, her portfolio grows to over $500,000, $503,000. So there's a $122,000 difference in savings because Mary's plan was cheaper than Joe's. So it's important you understand the fees and costs that are in there. And that kind of leads into my next question of what are the total costs of the plan. I'd be very skeptical of free and no fee plans because these are the plans that most likely have the highest revenue sharing agreements and have thus the highest risk of litigation, but yet show up with no fees in your plan. And so the money's being paid out, but you're not actually seeing it. And we mentioned on shows in the past, there are a lot of companies that tell you that they have no fees, one of which I know happens to have their licensing name on a big football stadium for an NFL team. And if they're not charging you any fees, I'm not quite sure how they're able to afford that. So be very skeptical of no fees, as that revenue sharing piece creates that conflict of interest inside of your plan. The next one is or before I get into that, I'm going to say what I usually do is there's a book that I subscribe to every year, and it's called the 401k Averages book. And what it does is it takes a plan size based on number one, participants, and then number two, dollar amount, and it has done an elective survey around the country as to what plan fees are based on those certain sizes of a plan, number of people in dollars. And I try to make sure, and it breaks it down. It breaks it down by third-party administrator, by fund management fees, by advisor fees, and it gives you a little bit of a range to work with. I try to make sure that my plans are well within the national industry average, because that, to me, is very defensible in the event of a fee audit by either labor or IRS. The second thing I want to talk about next thing to look at is, let's look at performance. I mean, performance is a big piece of the puzzle here. Even though there's no legislation, and in fact the Supreme Court has decided that they cannot rule against a company whose funds have performed bad, they can rule against a process by which the funds perform, meaning this: if I have two funds that invest in the same style of investment, but one has performed arguably better than the other, why would I want to have the less robust fund inside of my fund lineup when I know I can make my participants so much more money with a better fund or better performing fund over time? And that also leads me in one other direction. Be careful about indexing. The largest mutual fund or the largest investment in 401k plans relative to assets is the Vanguard Institutional Index Fund. The ticker is VINIX. Well, in 2008, it was down 37%. So just because you've got indexes that are cheap doesn't necessarily mean you're protected. And that's something you want to make sure you guard against. You want to ask your advisors, you want to ask your record keepers if you're being held to a suitability standard or fiduciary standard. I talk about this extensively. I hold myself and my firm to a fiduciary standard. A suitability standard calls for the plan providers to only recommend products that are suitable for their clients within an acceptable price range. That's it. A fiduciary standard, on the other hand, calls for plans to act solely in the best interest of the client, which means finding the best product at the lowest price. Advice given going back under a suitability standard, is heavily influenced by sales competitors promoting proprietary products and internal pressures to higher commissions, so forth. Advice giving under a fiduciary standard is unbiased. So in my plans, my compensation does not change based upon what I recommend. My I'm being paid for my advice. The products are the products. So since there's no vested interest for me to have one versus the other, one investment versus the other, I'd rather have the best. And the majority of plans that are sold through brokerage firms, the big boys, are typically prohibited from acting as a fiduciary and therefore only meet the suitability standard. And so something that you want to make sure you're aware of as an investment advisor, as a registered investment advisor, again, I'm held to a fiduciary standard, so I'm required to act in the best interest of the participants of the plan. My contract with the plan's trustee stipulates this in writing, and if my provider says they're held to a fiduciary standard, I have to make sure that I perform that. The next question, and I'm actually moving these better along, but the next question is, are mutual fund share classes available, are less expensive share classes than what are offered in the plan? I gave you an example earlier, the Diet Coke example, where I showed you or explained to you that I had a client that did not want to make a change because they just didn't want to go through the process. They didn't want to have to do anything. And I had to explain to them that as a fiduciary, they are required to make the change. And as a fiduciary, I am required to notify them of the change. And if they're unwilling to make the change to a less expensive or a cheaper same mutual fund alternative, I couldn't work for the plan because I know that I'm in violation of my fiduciary responsibility because there's cheaper alternatives that are out there. And so mutual fund expenses are huge. Sometimes, and in some cases, index options make a lot of sense. And that's something that you want to consider, is sometimes indexes could perform, like, for example, the S&P 500 index has been very difficult to beat with active managers over its history, and that may be a great investment alternative option, something you want to think about. Here's one question that I ask all the time, and the answer comes up as never. What changes have you made in the plan in the last 12 months? And the reason it's important is the nature of the world's capital markets have changed dramatic. Think about how many changes we've had in the world this year, last year, since 2008. And the answer is, how can you possibly be proactive inside of your plan if you're never making any changes? Well, my portfolios have held up relatively well, particularly in the last couple of years. But it's also I've been able to do well because I've been able to keep my plan flexible and make changes. I actually review every single mutual fund with all of my clients in the 401k plans on an annual basis, and I use a screening software that uses 11 investment criteria to evaluate that. And I kind of put my funds in this red light, yellow light, green light area, where green light funds are funds we're going to continue to use for the following year. Yellow light funds are funds I'm going to continue to watch, and red light funds need to be replaced on an annual basis. And by doing that, again, you're meeting compliance under ERISA 408B2 and under the Pension Protection Act of 2006. But at the same time, you're upgrading and constantly tweaking to get the best possible funds available for the participants in your plan. And that's really what we're trying to achieve here. So, as I go through all these questions, they're all reverting back to the theme of today's show, which is plan restatement and the regulations that are going to be required inside of your plan document that make you as a fiduciary responsible to make sure that you handle all of this stuff. I had made a presentation to an organization, a HR organization, recently, and one of the things I said was that the 401k plan used to be number 50 on your priority of things of importance, but because of the new regulatory changes dating all the way back to 2006 and being implemented now, it's going to definitely be in the top 5 in terms of things of priority that you have to be aware of on a regular basis, and not having the right advisors and team surrounding it, not having the experts that know this system, are only going to make it that much more difficult for you to comply with all the regulatory changes that are happening. And so that's an important thing to consider, and something I want you to ponder as we go into the break. We'll be back in a couple of minutes. You're listening to the In Black and Weitz radio program on Voice America Business.
Voice America Business Network, the bottom line in business.
ERISA 408B2, fiduciary standards, safe harbor, fidelity bonds, record keepers, discrimination testing. I am so confused.
Does your 401k plan have more questions than answers? Peter Weitz and his team of 401k experts have a solution. Their on-site service model distinguishes them from other service providers, and they are specialists in 401k costs, regulations, and compliance. If your 401k plan has more questions than answers, then contact Peter at 877-945-2888 or email him at peter@inblackandweitz.com.
Climbing Mount Everest is an amazing feat, and many have died trying to do so. However, more people have died descending Mount Everest than in reaching the summit. Part of the problem may be that people are so focused on reaching their objective that they fail to plan appropriately for what they will do or should be prepared for afterward. Similarly, people are so focused on saving for retirement and reaching retirement that they fail to plan appropriately for what they will encounter once they have actually retired. With 1 out of every 4 65-year-olds today living past the age of 90, you may be retired longer than you are actually working. Have you devised a plan, process, and discipline to ensure that you will not run out of money? If you are not sure what to do, then simply contact Peter Weitz and his retirement team at Fusion Analytics. We help manage human emotions using 3 proprietary investment techniques. Our job is to evaluate the forces that the typical investor can't see so that wealth is preserved and not lost. Find out more at inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. In Black and Weitz, we win by not losing.
The business community's first choice in Internet Talk Radio. Voice America Business Network.
You are listening to In Black and Weitz. To reach Peter Weitz or his guest today, please call 1-866-472-5790. That's 1-866-472-5790. You may also send an email to peter@inblackandweitz.com. Weitz is spelled W-E-I-T-Z. Email Peter at inblackandweitz.com. Now, back to this week's program.
Hi, thanks. Welcome back to the program. I'm your host, Peter Weitz. We've been talking today about plan restatement and 401k plan industry or sector, where the IRS has enacted all of their legislation dating back to 2007, and they're requiring all plans and all plan sponsors to restate their plan document. And I want to be out ahead of the curve and tell you all that since it's coming down the pike, you have to do it. It might be the right opportunity for you to start thinking about looking over your plan in its entirety. And I've spent the last segment talking about some of the things that you should be asking your advisors and your plan sponsors as you look at your plan. And I'm going to pick up with that now in that the next question I would ask is, do you receive any professional advice on investment decisions? And one of the primary reasons employees do not participate in the K plan is because they're confused about what all this means, and they have no idea about investing and have no interest. Well, we like to make sure that we're out in front of them, explaining to them what all of this means in clear and concise examples, and to make sure that they understand what they can and can't invest in and how it's going to be so important to their retirement. The next question is, do you use different mutual funds in your individual accounts and 401k plans? And my answer is I try to keep all of my plans fairly consistent on the funds that I use, so that if I were to make a change or I feel that one falls out of favor, I can make the change in every plan, and it's much easier for me to monitor. Are ETFs, exchange-traded funds, available? They are becoming a highly sought-after option that employees are looking for, and you want to make sure that you have the capability to offer that. The next question is the termination penalty to discourage my company from changing providers. There is one company out there that charges that, and as a result, their retention of 401k plans is significantly higher because plan sponsors, the company in which you work for, don't want to pay that fee. I make sure that whatever I shop for, we don't have any of that stuff. How do you choose the funds to offer in the plan, and why is it important? And I'm going to spend a couple minutes on this, but I look at 11 pieces of criteria by which to evaluate a plan. And I think that it's important that you look at all of this criteria because some are better than others. And I'm just going to go through a couple of some of the things I think about. The first is, obviously, first thing they look at is they look at plan performance. Okay, that's great. We're all going to look at plan performance. But let's look at plan performance and break it down. 2008 was one of the worst years since the Great Depression in terms of the investment market. Well, that was 5 years ago. So if you're going to look at the track record of a plan, let's look at their 5-year number because we're going to see how bad they did in 2008 as an evaluative tool. Mutual fund companies are licking their chops right now as we get deeper into 2014 because their 5-year number is going to erase what happened in 2008 as 2009 will be the new benchmark and the market's rebounded. So that's important. Performance is important, but breaking down how it rates in terms of the years of the markets is even more important. Management tenure is important. How long has the manager been working on the fund? If they're new, you might want to watch that. But if they've been around for a while and have had consistent performance, then I think that's something that is worth considering. If you go way back to the Fidelity funds, managers, there's Bill Miller at Legg Mason who's been, outperforming the S&P 500 on his value fund for 20-something years. The next thing I look at is, let's go back to the management. Do they have skin in the game? You're able to find out if the manager actually has invested in his own fund. I would only want to be a participant in a fund where the manager's got significant assets in it, because otherwise, why would I want to invest in something that they're not willing to invest in on their own? And so these are some of the questions that we look at. And there's several more criteria which we're happy to go through with you. We just don't have time for it today. You want to make sure your participants can make daily changes in the plan without having to pay any fees for going in and out. There are some funds that do have restrictions on trading. Particularly, I see it a lot in the emerging markets sector, only because it's very expensive for them to research. And so you want to make sure that you have the ability to trade in and out without having fees and expenses. But if you have restrictions, that's something you want to make sure you eliminate as a plan sponsor. Education is important. Education is something that I feel very strongly about, and I try to use simple examples. I used the Diet Coke example earlier in the program, but I use a great Starbucks example for people that say they can't necessarily afford to invest in their own retirement. And my example goes like this. If you give up 2 Starbucks coffees a week, which is, I'm going to use $4 at each Starbucks visit. So I'm probably dating myself at the moment because it's probably going to go up. But if you give up 2 Starbucks coffees a week over your 30-year working career and you invest that $8 a week, 30 years later when you retire, that $8 a week will have turned into over $60,000. So take it one step further. So if you can't afford to put away $8 a week, then you're going to be working for the rest of your life. But if you can turn that $8, which turns into $60,000, into $80 a week, then all of a sudden you've put away $600,000. And conversely, if you can, which is a lot of money, $800 a week, turns into just over $6 million. So it's a lot to think about when it comes to your 401k planning. And, most people that listen to this show are going to realize that their company's 401k plan is probably substandard and some changes need to be needed. However, they have a half dozen projects they're currently working on and another half dozen on the back burner, and they're probably never going to get to this. Well, the point of today's program is, if you're in this boat, the plan of action is to, if you are going to have to restate your plan document, and the answer is you are, it is important to have an expert take a look at your plan to make sure it complies with the vast majority of the questions that I answered today, if not all of them. And that evaluation process you might as well do it because you're going to have to restate your document anyway. Incorporate some of the changes that we talked about on today's program in your plan document. Make it more robust. Make it a better tool to attract and retain employees. And overall, make it more compliant with the federal government. I'm going to conclude with this, that if your plan needs to be overhauled, I suggest you do it today. But come up with a timeline. Don't waste any more of this period of time the government's requiring to do something else. Get the plan going and get it done and put it away and not have to deal with it for another 6 years. It's important. Your employees think it's important. Your future employees think it's important. You as a family should think it's important, and it's something you need to constantly look at. So again, plan restatement. The IRS has come up with this regulation. You have to restate your documents no later than April 30th of 2016. I highly recommend you do it, and you do a full scope review of your 401k plan at the same time. It's something we focus on. It's something we're passionate about. I'm glad I was able to tell you about it up front. It's been a great program. Thank you for listening. It's the In Black and Weitz radio show on the Voice America Business Network. Make it a great week.
Thank you again for tuning in to In Black and Weitz. Please join your host, Peter Weitz, again next Tuesday at 10 a.m. Eastern Time and 7 a.m. Pacific Time for another edition of the program on the Voice America Business Channel. Have a safe week.